Okay, so maybe you've learned a lot about investing in stocks and maybe picked out some stocks and things are good. And it's like, okay, well, that's great, but how do I actually go about buying them? What are the mechanics involved of actually buying the stock? It's like, I want to buy this stock, or I want to buy this stock mutual fund or exchange traded fund. How do I do it? Where do I go? Who helps me with such things? And that's where we're going to talk about here in this particular section, where we review all the different types of services that are out there on how you can buy and sell or trade stocks. We're going to look at the different types from full service brokers or brokerage houses, which is the traditional kind of, when you think about buying stocks, you go through a broker houses, but now there's a lot of different options out there. You have discount brokers or online brokers where you can get a lot more discounts involved with your buying and selling of stocks. There's online robotic or online robo financial planners where they're in between a stockbroker and a full service financial planner that gives you some advice or at least some ideas around building a portfolio. There's financial planners who not only help you with stocks, but they might help you with bonds and cash and other things and a total investment picture and all other things such as insurance and things a financial planner would be involved with. You can even buy, in some cases, a few cases, buy stock directly from a company. And we'll talk about how you can do that and which companies might offer such services. So I'll give you examples of well-known companies in each of these areas and different options that you have in there. I'm not recommending anybody in particular. It all depends on your particular need. You might like to use a financial planner versus, let's say, a stockbroker or versus an online type solution. They're all a little different, but you're going to be able to understand from this section what are the advantages and disadvantages of each of these types, and then you can decide, well, what's the best fit for me? Also understand the information changes frequently, especially with online investing and some of these robo investors and others where they might change things frequently, so be aware of that and always keep on top of that and do your due diligence as far as what works for you. If you feel more comfortable with investing on your own, you've learned some stuff in the course, you're like, I can handle this on my own, well then maybe like an online discount broker might be a way to go for you, or even a robo financial planner. If you're somebody who says, no, I need a little bit more help and want some help around my whole financial picture, just not investing in stocks, but in bonds and cash and insurance and a lot of other things, well maybe a financial planner would be the best choice for you. Either way, it's about you and your choice, but here we're going to give you the information on each of these things so you can make a good choice. So with that, let's go ahead and get started in this section and learn about different ways that you can go about buying stocks. Now, most people, when they think about buying stocks, immediately start thinking about brokerage houses or full service brokers or stockbrokers, right? You think, oh, I buy stock from a stockbroker. And that's really a full service broker is. They're stockbrokers, and they offer more than just simple buying and selling. They offer advice as well too. So they buy and sell stocks for you. They give you advice. They might call you up with a hot stock tip or something that they're recommending, or send you information or emails, or give you information to around research, or give you access to research, or they have access to tremendous amounts of research, and that's part of the advantage that they promote and say, hey, yeah, you might pay a little bit more for us, maybe a lot more for them, but the idea is you're going to get some stocks and recommendations that are very, very well researched. They basically can be set up to manage your portfolio on your behalf. You can decide how much authority you want to give them, but if you want to be completely hands off, maybe you'll have a conversation about like the types of stocks you have or how much risk you want, but you could say, you manage my portfolio for me. And that's how traditionally it was done, right? You'd hire a stockbroker and they would go and buy, sell stocks for you in your portfolio. Well, nowadays, people have a lot more access to information through the internet, through discount brokerages and online brokerages, and they want to be more hands-on with their investments. They want to be more of a do-it-yourself investor. So the use of full-service brokerages certainly have gone down over time, but still a lot of people use full-service stockbrokers, hoping to get better returns because of that expertise that the full-service broker will provide you. Now, some keys around this is one, trust. Your trust is not, you're dealing with a big, large brokerage house, maybe, for example, but you really are working one-to-one with a stockbroker, a particular person or individual themselves. So maybe it's a small company, maybe you got a team of people, but usually it's a one-to-one relationship. And the key part of that is you got to really trust that person. I mean, you're really betting on them to make the right choices for you. And you're paying a little bit more for that in comparison to other types of services. So you want to really trust that stockbroker and that they really have your best interests at heart. And that's been a real problem in the industry, where a lot of times stockbrokers are not necessarily looking at what's in your best interest. They might be looking more so on what's their best interest. We'll talk about that in a second here. Next is cost. Whenever you're evaluating any of these different options as far as actually the mechanics of buying and selling stocks, Well, there's always a cost involved with that. When you buy stock, there's a cost. And when you sell stock, there's a cost. These are transaction costs or transaction fees of buying and selling. And then from there, you can have all sorts of different types of other fees or costs associated with how you might have your account set up, or other types of more, interesting ways of buying and selling stock, or setting limit orders, or things we'll learn about here in a moment. But the idea is there's a cost associated with that. And full service brokers, like anything that's full service, like anything that is full service costs more, right? You go to a bank, or you go to a grocery store, and it's more of a full service where they put your groceries in the bag and take it out to your vehicle and give you a lot of personal service. Well, that's more full service than if you go to a discount warehouse place where you kind of do it all yourself. And you should expect to pay more at the full service place. With brokerage houses and full service stockbrokers, the same concept applies. You are paying more for that extra service. You're paying more for that research. You're paying more for that expertise. And you just got to say to yourself, is it worth it for that extra value that they're promoting? So really look at costs, like at anything you look at, but particularly with full service brokers, really understand the cost structure behind that and see if you're comfortable with that. One thing that's really been common in the full service brokerage industry, and it's been a bad thing actually, and has gotten better, but still something to be really aware of, and it's still a bad thing. That's called churning, and be aware of churning. So what I mean by churning is you pay a cost when you buy or sell stocks, right? Well, that's money that goes into the brokerage house. That's how they make their money, is by buying and selling your stocks. So they have an incentive to buy and sell lots of your stocks and keep turning over your portfolio over and over and over again. In fact, the more that they can turn over your portfolio, the more fees that they collect. Remember, they get paid when they buy or sell a stock on your behalf. So that's called churning, when they're basically just buying and selling stocks with the primary purpose of enriching themselves, not necessarily in your best interest, which is illegal. Now, with that, companies will say, oh, we're not churning, we're not buying and selling stocks, but there's been a lot of problems around it. So if you have a relationship with a stockbroker and they're doing lots of buying and selling of stocks, more so than maybe you're comfortable with, ask them, why am I selling this stock? Why am I buying this new stock? Why can't I hold on to this stock? What's going on here? And they might tell you some good reasons, but if you see a lot of it where it's turning over and over a lot, and you're really incurring a lot of fees, and you start becoming uncomfortable with that, that might be the time to really look for another full service broker if you want to stay with full service brokers, or look at these other options where it's more do-it-yourself that we're going to talk about. So beware of churning, just the rapid buying and selling, or the frequent buying and selling of stock, with the idea of enriching the full service broker. Now, full service brokers out there, who are some examples of them? Well, many household names that you might have heard of, like Merrill Lynch, been around forever, biggest brokerage house out there. So Merrill Lynch, Edward Jones, UBS, Raymond James, Wells Fargo Advisors, Morgan Stanley, Smith Barney. I mean, these big banks, these big institutions, these big brokerage houses have been around for hundreds of years, providing services to clients and providing full services to clients. So what's really happened in the more recent time is we went from a period where stocks were a complete mystery, and people who got involved in stocks had to hire a broker, and they really relied on their broker, and they talked about how good their broker was. Nowadays, it's more about them educating themselves, doing a lot more on their own, do-it-yourself investing, and really having some investment products that help them to be more, let's say, diversified, like with mutual funds or exchange-traded funds, and some lower-cost options than the full-service brokers. So the starting point is full-service brokers, top of the heap in terms of cost, in terms of advice too around stock trading and buying. But right now, there's a lot of other options that you might want to take a look at. So let's take a look at those. One of the biggest categories, and the fastest growing category around buying and trading and selling of stocks and other products too, but particularly stocks, is discount brokers. So you might also know them as online brokers or online traders. And you may know of them like E-Trade and Scottrade, companies like that. And we'll have some more examples here in a moment of that companies that you can look at as far as that can handle your buying and selling of stocks and other types of products. So they're discount brokers, they're online. And the idea is that it's more put on you now. You decide on what you want to buy and what you want to sell. They don't give advice. It's not like a full service broker where somebody's working specifically with you. It's up to you as far as what you want to buy and sell. A lot of the online brokers, though, as you go check them out, have a lot of great articles and information about buying and selling stocks. They have a lot of great tools and calculators and things too to help you research and decide on stocks as well. So you can take maybe some of the principles in the course, sign up with a discount broker, and then start using their tools to help you pick out stocks, mutual funds, whatever it is that might be of interest and work for you. So the key is they don't manage your portfolio, and since they don't manage your portfolio, that's where the discount comes in. That's where the heavy discounting comes in. So their cost to buy and sell stocks are much, much, much less than a full service broker. Because remember, you're not paying all those fees for the full service advice. You're doing it yourself. And now the broker, the discount broker, can use an online platform, drive out costs, reduce, personnel and all that on their end, so they can give you great pricing to buy and sell stocks. So it's a great way to get started with investing, actually, especially if you want to start small. A lot of these discount brokers can let you start with a very small amount of money to get started with trading. Go to the different websites. They'll tell you how much you need to get started. It's very, very low. Versus a full service broker that might need lots of money, thousands and thousands of dollars, of US dollars, let's say, to get started. So you have to evaluate between the two. So the key with a discount or online broker is you're doing it yourself, all right? So this is you applying your information, your education, things you're learning, and you're doing it yourself, and thus you're able to, capture a much, much lower cost. So you've got one extreme of the full service broker or a full service stockbroker that gives you all that advice and those high fees, and the discount broker, so it gives you lots of tools and access to maybe information and tools and research and calculators, but you're making those decisions on your own, but you're able to capture a much, much lower cost. So you can weigh versus your comfortableness between those two extremes. Some examples of some discount brokers and online brokers are names you've probably seen advertised a lot. They do a lot of advertising, so you might have seen them a lot. So companies like E-Trade or Scottrade or Charles Schwab, or there's new ones out there like Trade King and Options House. TD Ameritrade's been around quite a while. First Trade, Interactive Brokers, Merrill Edge, which is actually a part of Merrill Lynch, to have a discount arm, and even big mutual fund companies like Fidelity offer some discount brokerage and discount online things too. So if you have some mutual funds, look at your mutual fund provider. They might allow you to buy and sell individual stocks as well as mutual funds through them as well, and Fidelity has that as well. So you can see it's been a real popular area because the costs have gone down so much with buying and selling trading through this discount brokers that's really putting pressure on the full service brokers, and that's why some of those are investing and getting involved with some of that, like with Merrill Edge, for example. But the big players out there have been the big players for a long time. E-Trade, Scottrade, Charles Schwab, Trade King, Options House, and TD Ameritrade have been the big players for a long, long time. And they got a lot of different tools, and when you go take a look at them, some you might like better than another, just the look and feel of the thing, but they all essentially do the same thing, which is buy and sell securities, equities at very, very low prices. But remember, with an online broker or a discount broker, you're doing it all yourself, which is great. You get that great discount, and then you can do the investing. Because remember, you can always change your mind and buy and sell at any point, but now it's more on you to be the expert and have some expertise around your trades. And my hope is this course really helps you with that, and that you can take advantage of somebody like an online broker and enjoy those cost savings. Another way that you can buy and sell stocks and other things such as bonds and mutual funds and other types of investments is through a financial planner. You have like stockbrokers, full service stockbrokers, which are basically mostly about trading and buying and selling stocks. You have discount online brokers, which is all do it yourself, and also trading and selling stocks, where financial planners are real people that you would actually meet with. And their whole idea is to be a financial planner or a financial advisor for you, right? So they're not just focused on stocks, they're looking at your overall financial picture. So they look at things like stocks, bonds, cash, their whole investment aspect. But they would also typically look at areas such as insurance, long-term insurance, short-term disability insurance, health insurance, life insurance, whatever. There's a variety of products and services that they can provide that'll help you with your overall financial picture. And that's their key thing as far as a financial planner or advisor, is they're there to advise the whole part of you, of your whole portfolio or investments, all the things that you're doing, and give you advice on anything related to financial manners. And that's their key thing and their key role they do. And with that, they can do all the other stuff too. They can buy and sell stocks. They can make recommendations. They can give you advice. They have access to lots of experts possibly, or research. And their whole thing is they're supposed to stay on top of anything related to financial and the financial markets. And their goal is to really manage an entire portfolio on your behalf. So maybe with an online broker, let's say, where you're buying and selling stocks, well, that's just the stock portion. A financial advisor would say, how can we set up an entire portfolio of a mix of different assets, both stocks and bonds and cash and maybe precious metals like gold or real estate or whatever it might be? How can we set up a whole portfolio that meets your risk profile? And then my role as a financial planner or financial advisor, or their role, would be to help advise you on what to do within your financial plan. with your overall financial plan. So let's say if stocks have a big run up, for example, they might say, hey, we're getting a little too heavy in stocks. Let's sell off some of those stocks and rebalance our portfolio, maybe buy some bonds or some cash to help balance the overall portfolio. So you can see their role is to be more about that holistic financial planning aspect. Some keys around financial planners is one is trust is so huge. We talked about trust in the full service brokers, of course, that's very trust. But a financial planner, I think you need to even have more trust in that person because you're basically discussing everything with them. You might be talking about things like wills and inheritance and things like that. They might refer you to an attorney or a lawyer to actually draw up the will, but they'll talk to you about, the importance of having a will, for example, things that go way beyond just simply buying and selling stocks. So you need to have a lot of trust with your financial planner. And if you don't trust your financial planner, if you've hired somebody who's a planner advisor and you don't trust them, then you should really switch and get a different one because it's such a key part for your overall life and your overall financial life is this financial planner. So make sure the first thing is that you trust them. If you're doing it with a husband or a wife, that they trust them as well because you're a team in this and they should both agree on this financial planner and make changes as you need to. Now, financial planners, they need to get paid, right? Just like everybody, I guess, needs to get paid. And they're kind of in between that discount brokerage and that full service brokerage and the costs that are associated with that. And they can, and they advise on everything once again. And how they make money basically is either get a percentage of your portfolio or a flat fee from you. They also might make money on buying and recommending certain investments, certain mutual funds, certain investments too. And that can get a little dicey as well too, a little bit of conflict of interest. Are they recommending one fund because they make a little more money, especially like a load fund where they get paid a percentage right off by selling it versus a no load fund? That can be a little scary. Or is it something that's more about them helping you? Good financial advisors would be all about, if I can help you, I'll make my money by being good at helping you. And that's what you want to hear and what you want to see them do in action. So how do they make money? They make it on fees, and they make it either as a percentage of your overall portfolio, or they charge a flat fee based on the advice they give. So as a percentage of portfolio, it could be 2 to 3% of your overall portfolio on an annual basis. They maybe more actually. They charge a percentage of your portfolio to manage your portfolio of all your investments that they have with them. So if you have investments in different places, they might give you advice on that, but they're not managing that directly. It's only that you have with their particular company that they're managing specifically for you and giving advice to you on that as part of the overall financial plan. They might make money selling insurance and things too. So there's a lot of different ways they can make money, but the primary way is fees and as a percentage. So you got to say to yourself, gosh, if I'm paying this financial planner next year 1, 2, 3% or whatever it is, that's a bigger hurdle I have to go overcome now in my return on my investments. Now the idea is from the financial planners, they're going to help you get there in a more risk-averse way too, because they're going to look at your portfolio. They're the smart people with the expertise and give you that one-on-one counseling and consulting around financial planning. But you have to decide if it's worth it or not for you. But that's what they do. Financial planners give you that consulting advising. The other way they can do it is to become real popular with investors is flat fees. If I pay X dollars, you'll give me this type of advice, and I pay a flat amount. I'm not paying an annual percentage fee all the time. I'm just paying a flat amount. One time I had a financial advisor because I wanted to get a different opinion beyond my own. Even though I'm a long-term, real successful investor, successful investors know it's good to have another pair of eyes every once in a while, look at your portfolio and make sure you're not missing something. So I found a good financial planner and paid them a flat fee of $500, it's $500 US, to just look at my overall portfolio, see what was working well, what wasn't, and what advice they would have. A one-time flat fee for that. It was well worth it in that case. It's not something I do every year or every 10 years or anything like that, but it was something that I wanted to do at a particular moment in time as I'm reaching a point of maybe switching a lot of my investments around something that might be more oriented towards financial independence or retirement, for example. So I wanted to get a view of that. Particularly also I have a special needs son and who happens to be autistic, and I wanted to make sure I had some advice around that too, which is wrapped up in that flat fee and for things for him for when I might be gone. So I paid that one fee and boom, done, and that's it. So a flat fee could be a way to go too, especially at maybe milestone areas, milestone times in your life or every once in a while. So that's what financial planners do as far as looking at your overall investment and financial picture. In terms of financial planners that are out there, you could have some big national companies like Ameriprise, as big happens to be in the United States. Ameriprise might be some other large organizations out there. Some full-service brokerage firms might have a financial planning arm or present themselves as a financial planner as well. Many and most financial planners are smaller local firms. And many times they're just individuals, somebody working out of an office by themselves. Then maybe they have a couple assistants working for them to help with research, but they're basically, working, one-on-one with a portfolio of different clients that they have, helping advise those clients. And once again, these financial planners can be fee-based or percentage-based. So if you're interested in financial planners and a full-service financial planner, ask them how their fees, how do they charge. That'll be one of the first things you'd ask them in their meeting. And some of the key things to ask any potential advisor about in a meeting, and some good notes here, is talk about like their licensing. There's a lot of sketchy stuff around licensing with financial planners. They don't have the degree of licensing requirements that things like possibly like a financial broker or a stockbroker would have. So just be aware of that. They do have licensing. They have like things like CFP, Certified Financial Planner, where you have to do regular testing each year and pass exams and show what you're talking about basically. So that's a good designation. So if you see people with that, that's a good designation, a CFP or Certified Financial Planner. But ask about their licensing. Ask them how long they've been in the business. How long have they been in business? How many clients are they managing? So you get a feel for their expertise and their experience level. Talk to them a lot about philosophy too. What is their philosophy around things, particularly about investing or risk and those types of things, saving for retirement or whatever it might be that's of interest to you, and see how that matches up with your philosophy or your dreams or goals too. I mean, if you're more of a risk-adverse person and you want to try to have a good growing portfolio but maybe more safe, and your financial advisor is like the wild and crazy guy, like, I want to put as much money into growth stocks as fast as I can for you because we know we can make a big bang for the buck on that, so to speak, that might not be as comfortable for you because you really want to trust that person and be comfortable with them. Another thing to ask them about is, do they have any kind of specialization? You see a lot where maybe you have like insurance people who sell insurance, health and life insurance, car insurance, but then they are able to do some financial investing on the side, and then they kind of put it together and say, I'm a financial advisor. And at the same time, you got people really more like investors, financial stockbroker types who might then put a little extra insurance or things on their side, and they say, oh, I'm really a financial planner now. And then there's traditional people who really are that holistic financial planning, that they really approach it from that way. And that's who you want to deal with. If you're interested in the financial planner category, get somebody who handles all the aspects of financial planning and ask them, do you handle everything for us? We want advice on our overall financial picture. Is that what you do? Or do you just do the insurance part? And then, because you can always get an insurance person, you can always hire a stockbroker or use online discount brokers or different things for your if you want to cobble all this together, which is perfectly fine, and have different people doing different things and different specialties. But if you want to have that one financial advisor to advise you on everything, just make sure that they do that, and they might have a specialty or an area of expertise, but they're just not trying to do something on the side and calling themselves a financial advisor. They should be able to give you good advice on everything. Okay, so we've looked at a couple of things here. So financial advisor, looking at your whole financial picture. Full service stockbroker, look at full service advising on stocks. You can do discount brokering online. Now we got a couple others we can look at too as well, including robo-advisors, which are really a growing area right now, these robo-advisors. So let's learn about robo-advising. So maybe you're thinking like, well, I like the idea of this financial advisor, or somebody who can at least manage my investment portfolio for me. But I don't want to pay a lot of fees for it. Is there a better way? Is there a way I can get almost like financial advice online cheaper than like getting a full service in-person financial advisor? And the answer is yes. The wonders of the internet and the wonders of the technological age have really helped drive down costs and provide more options for people, particularly for investors. And this is a growing, very fast growing area called online financial advisors or robo-investors or robot investors or online financial planners or robot financial planners. And what's the robo or the robot part? Well, it's based on the wrong algorithms or based on putting together portfolios and then managing that along risk and doing that automatically without being more specific one-to-one to somebody, but putting you in a pool of investors based on things like risk tolerance. So let's walk through this real quick and it'll make a little bit more sense for you. If you've ever heard of like companies like Wealthfront or Betterment, and we'll look at some examples and specifically around them so you can really see them in action in just a moment here in the next lessons, but those are companies that are robo-advisors. So the old idea of a robo-advisor is low-cost portfolio management. It's saying, no, you don't need to hire a full-service stockbroker. We can do this at a low cost. In fact, we can actually manage or make recommendations based on a portfolio for you, so you don't have to try to do it completely by yourself either. You don't have to be a discount online buyer and seller through an E-Trade or Charles Schwab. We can actually manage your portfolio for you at a much lower cost. So the idea is that they build a portfolio for you of stocks and bonds and different investments. They build it for you, and then they manage that investment for you, and they also rebalance. When things go up too high, they sell those off and then buy something that's low to continually rebalance to your portfolio so you stay within your risk tolerance. Sounds pretty good so far, right? They're going to do all that for you. They have very low fees, very, very low fees. And so they're going to do this at a much, much lower fees than certainly a stockbroker could do. But even then, if you're doing it yourself from buying and selling stocks, like with an E-Trade or an online discount broker, or certainly a financial planner where you're paying a flat fee or percentage for just the advice part of it. So they're going to have very, very low fees. So how do they do this? Well, first thing they do is they use a few low-cost ETFs or exchange-traded funds, right? We talk about index investing or exchange-traded investing where it's very passive. There's not an active manager buying and selling stocks, just a reminder on that. So index investing is you buy the index and then you want to try to match the index. And it has the ability to have very low cost because you're not buying and selling all the time in that side of the mutual fund. They're just trying to match the index. So lowest cost mutual funds are index funds, or in this case, exchange traded funds, which are traded on a market but act like an index fund, that are going to be very, very low cost. And then what they do is they have a very few number of different funds that do different things. It's a large cap stock fund and a small cap stock fund, or it's an international fund or emerging markets. Maybe it's a bond fund. They got some bond funds. So they have a few funds that they have chosen that are very, very low cost funds. Some might be from companies like Vanguard, for example. They might choose those funds because they're the lowest cost, good funds, follow the index, and they choose from those 5, 6, 7, 10 funds, whatever it might be, to build a portfolio. Now, how do they build a portfolio? They've never really met you or anything like that. How do they give you financial advice? Well, they build your portfolio based on your risk tolerance, right? So what they do is they have you do an online survey, and you basically from that it'll spit out, and you might give some feedback, additional feedback too, but it'll spit out saying, oh, I'm a very risk investor. I like to I'm aggressive when it comes to risk, so I can take on more aggressive stocks, or I might be more moderate. Or your survey might say, no, they're a very conservative investor. The survey might ask you things like how far away you are from retirement or reaching a certain financial goal to factor that in too, right? If you're 2 years away from retirement, you don't want a bunch of risky investments. You want more conservative or safer investments. Then if maybe you're 20, 30 years from retirement, if that's your goal, then you might want to take on more risk to get better return. So the survey that they do with this, basically they'll do all sorts of, you answer questions, they'll do all sorts of calculations, and they'll spit out saying you are a moderate aggressive, or you're aggressive, or you're a conservative investor, whatever it is, and then that will also then spit out automatically a recommended portfolio for you at this moment in time. And it'll be this much in a total stock market fund, this much in dividend stock or ETF fund, exchange traded fund, or this much in an ETF for bonds, and they'll build that portfolio for you. All low cost, all exchange traded funds. If you like, let's say index investing, or building a portfolio of just index funds, that's what they're doing for you. They're just doing a little bit more because they're figuring in your risk tolerance, and then they're balancing and balancing these funds amongst each other continuously all the time based on the robot part, the algorithm part. So it's based around risk and reducing costs. As mentioned, some examples are out there like Wealthfront and Betterment. So it's a great choice. So who's this a great choice for? Somebody who might be not as understanding of the market. Somebody who wants to get involved with investing, maybe do a little bit more in investing than they've done before, but not ready to take the big plunge and buy and sell stocks on their own, for example, especially individual stocks. But they like the idea of that index investing. They like that idea of exchange traded funds. They love the idea of keeping costs low, but they'd like somebody to maybe give them some recommendations based on their risk tolerance and build something for them so they don't have to think through how to build it themselves. This course will help you as far as building yourself. You can do that. But these funds, or excuse me, these companies are providing a great service for someone to get started right away and start learning the market and get going, and pretty inexpensively too, to get started and start seeing how things are working and having a little bit more professional management behind them versus, let's say, totally just doing it yourself. So they're really growing in popularity, especially with the millennial generation, the technologically savvy generation. But whichever generation is growing in all those areas, and it's very popular because think about it. It's like I'm getting some okay financial advice. They're managing my portfolio for me, but I'm doing it at such a low cost, and I don't have to pay big bucks for some stockbroker who maybe I'm worried about if they're churning or buying and selling to enrich themselves, or a financial planner giving me advice. This is based on tried and true types of methodologies of index funds, exchange traded funds, bought and sold to rebalance, and driving down costs through these low-cost funds. So if you like that, you might want to check out these robo-advisors, and it might be a good fit for you. In this lesson, we're going to take a look at one of the big robo-advisors out there, and that's called Wealthfront. So we'll go in there, do a screencast, and you can kind of get a peek around as far as what the site looks like and how it works, and I'll give you some opinions as we go along, and maybe Wealthfront or some of its competitors like Betterment might be right for you. We'll take a look. Okay, here we are at Wealthfront. Simply wealthfront.com there, and Wealthfront is a robo-advisor. They basically are in between that full-service financial advisor and you being kind of a do-it-yourself advisor. There's several other companies out there as well, like Betterment, that we'll take a look at. But first off, let's look at Wealthfront here. And we'll actually run through how they kind of do it and how they get started here. But first off, a couple things that they emphasize so you can kind of see what what their positioning is from a company. They talk about how investing. And one thing that they do is that really stands out for them is they've got on their team Burton Malkiel, I'm probably pronouncing that wrong, and Charles Ellis, who've written some real famous books out there, particularly A Random Walk Down Wall Street is a very famous book, one of the top sellers. If you go on Amazon right now and look at top sellers of business books, investing books, Random Walk Down Wall Street will be there, as well as Winning the Loser's Game. So on their team that's helping to advise them on putting together these portfolios for people are these two leading folks, and certainly as far as their expertise and philosophies really tie into that, and they really heavily promote that. Now, how involved are they in the day-to-day operations a lot? Who knows? I have no idea. Maybe they're just a consultant, maybe they're an advisor, maybe they're part owners, maybe they're really involved. Who knows? But they're trying to follow these kind of philosophies around it with these folks. So they really promote that. And these are good books. I'd recommend these books. I think they're pretty good books. So particularly Random Walk Down Wall Street is a very, very famous book. So they look at that from a philosophy standpoint. Next, they talk about cost. Well, what does this cost to do? And how they do is a little different than having a pricing chart. They got this kind of calculator here. And you can see on the bottom where it says account value, it currently says $100,000. One thing about both Wealthfront and Betterment, if you're not from the United States, it might be when you log in, let's see if it gives you in pounds or in your currency, or if you can even do it, because as we look further, there might be things that this may be limited to U.S. only, but something to take a look at. Because I'm based in the U.S., so that's what I'm seeing. So if your account value is $100,000, what you pay them every month is $18.75 as far as their fees. And they'll put together a portfolio, they'll manage it, they'll do these things we're going to look at in just a second, but you basically pay them $18 a month if you have a $100,000 portfolio. Now, the nice thing about some of these robo-investors, particularly Wealthfront, and Betterment too, but if you have a low amount you want to get started, and let's say your account value is $500, and they're going to ask you to continue to invest in stuff, but you pay no fee at all. They actually have a way to get started without paying a big fee. Or if you have a small amount, like let's say, it's hard to slide this thing, but that's one criticism there, but you get the idea, is let's say my account is, I'm going to go down here, is 11,000, let's see, it just jumps up, $20,000. Well, I pay $2.25 a month on $20,000. And if you got a lot of money, you just keep sliding it over. If you've got $630,000, you pay $129 a month. So their whole thing is that they're going to put together a portfolio view of low-cost funds or low-cost investments so they can keep your overall fees down, is the idea behind it. So that's one thing why they put up front here is they're really trying to keep your fees down, and they're going to do all this investing for you, right? You don't have the time to do investing, they say, so you're going to, they're going to manage it for you, which is really nice. It's really good if you want to have kind of a portfolio that's kind of automated and doing it for you. Once again, they're in between that full-service advisor and doing it yourself. And different things they do some things like tax allocation, commission fees, diversified portfolio, all sorts of things that they set up there for you. If we look at, let's say, why Wealthfront, a couple of things on there. One thing I'd look at is, let's say, like our low fees. Once again, these things could change at any point in time. I'm just showing you, the current example on there. Also, I don't represent Wealthfront or any of these robo-advisors. I actually don't invest with them because I'm an expert in this, so I do it myself. But this is would be something, especially if you're a younger investor or less confident, maybe this might be a way to look at. And they talk about the cost here is first $10,000 is managed for free. That's pretty good. And then low 0.25 annual advisor fee. That's a typical index type fund thing versus, let's say, 1 or 2% or more on actively managed funds. They do look for an account minimum of $500, and you can actually invite your friends, basically be an affiliate marketer for them, and they'll give you a break on it. So FAQ and some things you can check out, and they give you an example of how fees add up over time, which is true. Fees add up over time. So they're very much trying to manage it for you, low fees, be tax efficient, and follow these methodologies as far as investing and passive investing, and let the indexes and things work for you. They'll talk about who we are, and they'll once again emphasize their different experts that they have in there that they've brought on board, and and how they kind of do it. And also, under what we do is they'll share a little bit more information on there too, the different types of accounts they have, retirement, non-retirement. Once again, this is another indication, might be really U.S. only, 401k, Roth, that's our USA type things. And it talks about the benefits of diversification and how they do their diversification. I believe I saw somewhere that they have like 11 different funds that they use to give you diversification. So not like hundreds or thousands, they keep it pretty tight, and you can see some of the examples here. But we're going to actually sign up, well, sort of sign up. We're going to get started with it so you can kind of see how it works, and and see if this is for you. So we go back to the home page. You can get started with Invest with Wealthfront. I'm going to go a little ways without having to actually sign up, but you can kind of see how it works. First thing they're going to do, and what these other robo-advisors do, is try to get an idea of your risk tolerance and get an idea of what some of your goals are. And so they might ask you some questions around that. And Wealthfront does a nice job of asking some good goals. Now, this is a little salesy too, because once you pick something like, I'd like to create a diversified portfolio, well, that makes sense. Like, great, at Wealthfront, we do that. Yay. Well, wasn't that something? So let's say I'd like to save money on my taxes. Sure. I like someone to completely manage my investments. Well, that's the main idea of having them. If you're doing it yourself, then you don't need Wealthfront. I'd like to match or beat the performance of the markets. Well, who wouldn't at least like to match, right? That's index investing. And, good news, they do that too at Wealthfront. Well, okay. But if somebody was really interested, let's say, on one particular thing, they could highlight that, and maybe it'd be all about, let's say, performance or something. But we'll pick all of them because they all sound pretty good. What is your current age? I'm going to put in here. There's a lot of folks that are younger actually use Wealthfront. They're probably about 2/3 to younger versus like millennials versus, let's say, boomers, from an age range. So let's say somebody's getting started, and let's say they're 27. All right, maybe they're going to start low. Let's say 30, just a round number. So let's say we're going to get started with Wealthfront. You're 30. You could put in whatever number you are, so you don't have to sign up. And let's say I have $30,000 U.S. in pre-tax income. So this how much I'm making a year is $30,000, right? Let's bump that up. Let's say I'm now making 35. Let's say I'm making 35,000. Well, that's terrific. But you put in whatever number you're making. And what's following best describes your household: single income, no dependents, like no children, single income, at least one dependent, like a child, dual income, and all this kind of stuff. So I'll say it's dual income, no kids or dependents yet, just me and maybe the wife or your spouse. What is the total value of your cash and liquid investments? So what would you be bringing into Wealthfront is what they're kind of asking. It could be very small. It could be a large amount. Let's say I've got $30,000. I'll just leave this here. Let's say I've got $30,000. So I'm 35 years old, and I want to invest $30,000 with Wealthfront. I'm maybe transferring some stuff over and to get started. When deciding how you invest your money, what do you care about more? Maximizing gains, minimize losses, both equally. Somebody who's very risk averse would want to minimize losses. Typically they'll pick. If somebody was, let's say, I just want to maximize gain, I'm real risky, then I might pick that. So let's say we want to do both equally. We want to be kind of more of a moderate investor. We want to get some gains, but we don't want to get crushed in our losses. We don't want to be riding the wave all the time. So I click that. Global stock market is often volatile. If you lost 10% of its value during a month during market decline, what would you do? So your whole portfolio goes down 10% in a month. This is a gauge to see what people do. Some would be like, oh my God, I got to sell. This is like terrible. I'd sell all my investments or sell some. Some would keep all of it. Some would buy more. You just choose whatever you want to choose. If you're a modern investor, we're going to use this person as a persona, as a modern investor. They might say, well, we might keep it all. We're just going to buy and hold, and we're going to keep. We won't buy more, but we'll keep what we got. All right, so answering those questions, they're now going to look to create, quote, the optimal plan for you based on their philosophies and things. Remember, this is their philosophies, which could change at any time. They're doing this for you. Then you put in your email and you can get your plan, and they can start marketing to you and get you all set up, right? But I'm going to close this just to take a look at the plan, because they actually give you that, which is really nice and transparent. I like that. That's pretty cool. All right, so this is a taxable investment mix versus, let's say, a retirement investment mix. Maybe if you had like Roth IRAs and 401ks, those numbers would probably change, and they do. You see, for a retirement mix, they get a little higher in income type stuff because of how retirement things in the U.S. and their IRAs and 401ks, there's some benefits to that. But let's say this is taxable. This is outside my 401ks or taxable account. This is just money I've got to invest. All right, so my risk tolerance, they say, is an 8. I don't know what that means. That's on a scale of 1 to 2 or 10 or whatever. But I can lower my risk or increase my risk level, and we'll see what happens to my investments or my portfolio. We'll do that in a second. So based on the fact that I am 35 years old as this example, and I have $30,000 to invest, and I answer the questions to be kind of a moderate type person, I could always go back and change my answers by the way here. But I'm a moderate person. In fact, if we go over here, it talks about how they came about with this thing based on your targets and your things. But here's your diversified investment plan. So they basically got me 35% in U.S. stocks, 22% in stocks outside the United States, 17% in emerging markets, got some dividend stocks, 8%, a little bit in natural resources. That's interesting. A sector right in natural resources like oil and gas, that type of stuff, timber possibly. And municipal bonds, and this is why another reason why I wonder if this is really U.S. based, because municipal bonds are bonds by cities, and there's a lot of tax advantages in the United States if you own municipal bonds inside the state where you live. There's going to be a whole course on municipal bonds, but if you're one of my students who are outside the United States, and I'm really blessed to have many students outside my United States, go to Wealthfront and just see what it does. If it asks you things like, what country you're from or whatever, it might. So it might not be for you. That's all I'm saying. Maybe this is strictly U.S. based. So with that, you can see, wow, that's pretty. I've got like 13% in bonds, and it's all in municipal bonds. The rest is in stocks. If you see this, natural resources, dividend, emerging market, foreign stocks, U.S., the rest is in stocks. And if you look at foreign and emerging market together, well, what is that, 22 and 17? That's 39%. That's pretty hefty, in outside the United States as far as what a lot of financial planners, a lot of people recommend. And that could change over time. Maybe their advisors and their team thinks U.S. stocks are overvalued, so they're looking for, these foreign stocks or emerging markets. At the time we're looking at this emerging markets, we're down, for example, so maybe they're trying to buy low. Okay, so that's my portfolio that they gave me. I could then sign up. I can change my answers and change my portfolio. I could change my risk tolerance here. So I could, go, let's say I want to lower my risk. Let's say it was originally 8.0. You see where it says I'm going to lower my risk tolerance. So I don't want to be as risky. See how my stock portion went down and my municipal bonds went way up? Because I'm trying to take out that stock, that volatility risk, and getting more into bonds, which will help minimize risk that way. But if we were back at our 8, or let's say we go higher to all the way up to 10, I guess is the maximum. So that's something real risky. You can see very little in bonds and all that. I bet if I changed my answers, let's lower this back to the 8. And I bet if I changed my answers, this is the whole thing here. I bet if I changed my answers, then it would change too, but also it would change based on the original number I put in. Remember when I started here, Invest with Wealthfront, and there was a part where it asked me my age and things like that. If I put I was 60 years old, it would probably give me less risk investments as well. So the idea behind all this, just showing you a little bit, once again, I don't work for Wealthfront, not recommending them or anything, I'm just showing you what they are. And the idea is that you could get this plan that basically they spit out for you based on these answers to your questions. And then they'll actually manage it, and they'll do some tax efficiency things where they're actually buying and selling types of stuff with tax loss harvesting. It's in the course talk about tax loss harvesting, where you're selling your losers, the things you've lost money on, and buying more winners, and that you can actually then use those taxes towards that. So there's some tax efficiency in there, which is good. They certainly talk about their low fees that we looked at before and how the fee structure works. That's working nonstop. You can set it and forget it. That's the whole idea. You just sign up, you set it, they do all the stuff for you, they buy and sell for you, and you can always check your account balance anytime, and the dividends are automatically being reinvested for you, which is nice. You don't have to do anything. You basically set it and forget it. That's the idea of all these robo-investors, and that's the idea behind Wealthfront as well, too. So that's Wealthfront. If you're interested in them, check them out. There's a lot of other ones, too, like Betterment and others we'll take a look at, but that's Wealthfront, and might be it's a kind of a newer type thing where it's not a full financial planner where you go into the office and you sit with them and you have this whole discussion and big whole sorts of things about goals and stuff, but it's not completely do-it-yourself either. It really is in between where it's like, I'll answer some questions and they'll spit out a portfolio for me. Though even look at the portfolio we did, for me even who takes I take on a lot of risk and stuff, even I'm looking at that like, that seems a little risky, but they're using their experts to make these recommendations, and who am I to say that they're not right? So Wealthfront might be a robo-investor for you to check out. In this lesson, we're going to look at another robo-investor or online financial investor that puts together a whole program for you, and that is Betterment, very much like Wealthfront. The idea is you put in some information, your risk tolerance, some other types of data, and they'll spit out a portfolio based on that information, and they'll automatically set it up for you and manage it for you and pay manage the taxes and everything for you is the idea. Very, very low cost. It's all done through the internet. So let's take a look at Betterment and learn a little bit more about that. And I'll share some insights and things along the way as well too. Just like any of these case studies, whether it's Wealthfront or Betterment or any of these folks, I don't do business with them. I'm been investing for a long time, so I do it myself. That's why I'm teaching the course. But it's a good thing for somebody who might be starting out investing, maybe doesn't have a lot of time and wants to maybe explore these options. So that's who it might be a little bit more for, something where it's in between completely doing it yourself and the other end of the spectrum where you have maybe a financial planner who you're paying to do it for you as well. These guys are in between with some low fees, all done on the internet. Very popular once again with younger folks, by the way, too, with the millennial generation is grasping on these programs more so than others. So let's take a look at Betterment. Okay, here we are at Betterment, betterment.com, and it's, I guess, better your finances is the idea behind it, right? So this is betterment.com. Once again, I don't get any kind of financial compensation or anything from them. It's just something that's out there that I want to make sure educationally that you're aware of with these robo-investors. So first off, Betterment, one of the larger ones out there along with Wealthfront. You can see they have $5 billion in assets. These web pages change all the time, so I'm not going to continually update the lesson here because you can go out there and take a look at it yourself. But the concepts will always remain pretty much the same with these guys. And we got a part here where it says getting started, and you put in a couple basic things and you get you started. And we're going to do that in just a second. So, but I want to give you some highlights from Betterment here, but then we'll actually do a kind of a sample portfolio so you can kind of see what it looks like. So first off, what they do, they're pretty transparent. I like that about them. They talk about right up front, we invest in low-cost index funds, really it's exchange-traded funds, what they're investing in that as opposed to like a mutual funds. You can talk about how their fees compare. They give you personalized financial advice, but it's really more about you putting in the inputs and then that creates an output. So it's not like you're talking one-on-one with folks or anything like that. Maybe if you got like 500 grand in assets or more, they'll answer the phone. I don't know. But the idea is you put in the information, they'll then build a portfolio based on that information for you, and then they'll help manage it for you, buying and selling to meet your risk level too. So it's really very much a hands-off type approach from you once you get started. And like others, they have some team of experts here, and they're trying to automate, which is good. Automation is good, and trying to manage and lower taxes. They'll do things like tax loss harvesting to try to offset your gains with your losses as they manage that portfolio for you. All right, so there's lots of things that you can look at from there. One thing that's nice too is they actually share their portfolio, what they pick from in here. So if you go through, you'll see this is what it'll look like when we do it in a second here. But they'll create an optimized allocation. They use 12 different asset classes, basically, within stock and bond exchange traded funds. So it's not getting the gold or cash or anything like that. It's really stocks and bonds. So that's one limitation of many of these types of programs. But the nice thing that Betterment does is they actually tell you what they're using. They actually are very transparent with their stock and their bond ETFs or exchange traded funds. And exchange traded funds, once again, act like index funds. They're tracking the index, and their idea is that they're designed to be very low cost. And you can see on the left here some of their stock ones they have. They have a total stock market, large cap value, big cap stocks, mid cap value, small cap value, international developed stocks, emerging market stocks. And then over here on the bonds, you've got short term, inflation protected, which is the short term is U.S. Treasury, which so that's United States based. This could be very United States based. So if you're outside the United States and you're watching this course, these robo-advisors might not fit you, and that's just be aware of that. So take an understanding of that. Because when they talk about IRA and 401k accounts, that's definitely United States. Those are types of tax advantage 401k accounts. Municipal bonds, those are cities in the United States. So and you get some tax advantages from those. And then they go into corporate, international developed and emerging market bonds, a little bit more riskier bonds. So this is what they're choosing from these 12 of all the gazillions of different funds out there. This is the 12 that they're choosing from in these broad-based, index-based exchange trade funds to drive the cost down. And you can see one thing they do nice is they show who is actually doing it. And these you can see there's a lot of Vanguard funds here as a low-cost provider. They got some iShares here as well, as far as with their municipal bonds. And the nice thing is these are real actual funds and stuff. They're not making up their own stuff. This is actually Vanguard. You could click on, let's say, this large cap fund, for example, and it would actually pull it out and put it right into the Vanguard website and show you that particular website and show you that particular fund. So they're going to build this allocation for you is the idea behind it. And if you go into, and they got different types of accounts you can open, from retirement to trust to different things. They give you some information and resources, which is nice. Let's take a look at pricing here real quick, because that's pretty interesting. Where Wealthfront had a little calculator and you kind of do the slide rule thing, they do it where they'll show you based on your account balance. So you can get started real low with these robo-advisors versus, let's say, buying just a particular mutual fund or trying to set up a financial plan or brokerage account that might not like to do that with you. These guys, you can get started very low. I mean, you can see, you can do $1, I guess. This is all in U.S., but up to almost $10,000 U.S., your annual fee is 0.35, right? And that's if you keep putting in $100 a month every month into it. You pay a 0.35%, so very low fee on your account. And as your accounts get bigger, up to almost 100,000 or 99,999, you're at 0.25%. And if you're 100,000 plus, then you're at 0.15. And as you get to these over 10,000, you don't have to keep putting in that recurring deposit. Recurring being like, every month I'm putting in a certain amount of money. In this case, it has to be $100 a month to really qualify for this. Otherwise, you got to be at the $10,000. But they talk about some of their no fees that they do, no rebalancing fees. That's one of the big things with any robo or online investing service or program. Their whole idea is that they're going to automatically rebalance for you. You don't have to do that. You don't have to think about that. The whole idea is they're trying to take your thinking out of there. You're just basically going to put in inputs, and they're going to do the thinking for you. They're going to do the investing for you. And your whole thing, do it at low cost and manage dividend reinvestment and manage taxes. As far as taxes you're incurring, you still got to do your tax forms, but they're going to manage the taxes you're incurring and try to minimize that and do that all for very low fees. That's the whole idea behind these guys. And they'll give you some comparison here as far as versus, like, let's say, full service type financial planners. And they're going to be less expensive than a full service financial planner, without a doubt. That's their whole mode of operation. We're not going to give you a lot of advice. We're going to take some inputs and then we're going to give you some advice. So let's get started here. So as an example, right? So the first thing to do is they ask you how old you are. Well, let's say I'm 30 years old. Well, if you'll see my videos, I'm not 30 years old. I'm much younger than that. Well, actually, I'm older than that. But and then you put in, but we're going to use an example of somebody might be a younger person, because a lot of people use these services tend to be younger people. That's probably 2/3 of their business or more comes from 30 and under folks at this point. Whether you're retired or not retired. So we're going to say we're not retired. We're trying to save money to retire in the future, right? And they're going to ask you what your annual income is, right? So how much you make in a year. So let's say we're making, so you're 30 years old. Let's say we're making $35,000 a year. Just you put in whatever number you want to put in, whatever's appropriate for you. I'm not 30. I'm much younger, older than that, and I'm making more than 35,000 too. But we can put this in. This is an example as a persona. So for this is where this 30-year-old making $35,000, and what it's going to do is it's going to ask me a question. So first I'm going to select a goal. Remember we talk a lot about in goals around investing. So maybe priority one is I want to save $8,000 for 3 to 6 months of unplanned expenses. Right, so that's the number they're using based on what you put in. So let's say I've already got my safety net. I've got it in my bank, so I don't need a safety net. What I want to do is I want to save for retirement. Right. And this will even say, this I want to save for this type of retirement, let's say, long-term type thing. And it's saying I'm going to be at 90% stocks and 10% bonds, and this will give me a retirement of $36,000 a year. I mean, in a regular taxable account, as opposed to, like, let's say some of these US-based IRA other accounts. So I'm just going to set up a regular taxable account, and I'm going to save for retirement, and I could read more, but let's just select this goal. Remember, I'm 30 years old, 35,000 income. What I'm focused on is saving for retirement. This is what they're saying, so let's see what comes out. Okay, so what they're saying, a recommended allocation of 90% in stocks and 10% bonds, and that they're considering a moderate risk allocation. You can always adjust it, they say, but that's considered moderate risk. I will tell you that any financial planner would say that is that is a more aggressive type of allocation. Now, this is their plan. This is what they're setting up, particularly with the potential for interest rates to rise on bonds and things. Maybe this is why they're trying to stay away from bonds, but that's a pretty heavy allocation to stocks. And if this particular portfolio is going to go up and down a lot, it's going to be very volatile. But that's okay. Maybe I would say that's once again more of an aggressive investor, but I'm okay with that number because I'm an aggressive investor. Even me, I'm like 85 or 80-20, but I'm older. But at 30, you have a long investment horizon. Maybe that's the right number. You have to be comfortable with that. But I'm going to say that most investors, most people I talk to, that could be a little heavy for them. But it's up to you. It shows you can click on the little things and it'll tell you what's invested in each of these little buckets. Or easily you can click on details and it'll actually show you here, how much is invested in each thing. So not only am I heavy in stocks, they'll break it down like how much is in the total stock market, how much is large cap, how much small cap, whatever it might be. And as you can see here, what they've done is they've put a lot in developed markets and a good chunk in emerging markets too. So this would be outside the United States in developed markets, maybe like European Union, that kind of stuff in developed countries versus, let's say, more emerging markets that might be out there, like even Brazil and others are a little bit more emerging than, let's say, Nigeria, for example. All these countries are following one of these categories. So if I look at this, I can see 47 and 48% is going to be in international stocks of my overall portfolio. That's a pretty big chunk. So this is going to add even more volatility around that too as well. And you can see my bond part, pretty minimal. And a lot of that's in real safe United States city bonds, relatively safe United States city bonds. So, in bonds. So this stock portfolio would be one that in this example, and this you want to put in your own numbers, but in this example, I would say this is very volatile. It's going to go up and down a lot. And you better be comfortable with that if you want to do this portfolio. But they're saying this is going to outperform the market and this is going to work best for you. You put in there, they'll manage it for you. They'll lower your fees. And later on, if they decide like, wow, maybe developed markets isn't the place to be, they'll sell off some of those and buy U.S. large cap or small cap, whatever. They're going to manage that for you. Once again, you're basically putting your trust in them to do all this automatically for you. The benefit that they're going to give you is that automation. They're going to do it for you in low fees and low cost to do it versus, let's say, a full service financial planner, or versus, let's say, you putting together your own basket of mutual funds or index funds or exchange traded funds. They're going to do it all for you. So that's why a lot of younger investors like this, people who have less education around investing, because like, oh, I'll just give you my money. You're going to be low cost, which I like because I hear these financial planners can be a little expensive, and just do it for me. And if that sounds like you, then this might fit. If it doesn't sound like you and you're learning stuff from this course, maybe you want to do a little bit more. Maybe you try a little bit in Betterment or none, or in any of these robo-investors, and you put together your own type of portfolio. That's certainly what I do. I don't have any money in Betterment. I don't have any advantages to promoting Betterment or anything, or Wealthfront or any of these robo-investors. I do want to make sure that you're aware that they're out there because they're really growing and they provide a nice service. Though as I look a little deeper in them, I would caution you to look deeper into them even still as far as if it fits you. But low cost and diversified portfolio, they can kind of do it all for you without you having to do it yourself. So that's Betterment. Their website might change every once in a while, so check out for the most current website versus what I'm showing you here. Oh, by the way, one other thing is I only put a little bit of information in here. They didn't really ask me a bunch of questions around my risk tolerance or too much around that. So that might have been a little concerning for me too. Maybe if I actually signed up, it would get in more detail and then really hone it down. So maybe it's not fair for me to say that they're going to always be 90-10 based on that criteria. So check it out for yourself, and it's low cost to get started, and maybe Betterment and Wealthfront and these other companies are for you. If not, do it yourself, or you can use a financial planner. But the things you're learning in the course will really help you with any of these types of services. One way that you can buy and sell stocks, even individual stocks, is sometimes through your own mutual fund company that you're using. You might be using Fidelity or Vanguard or Charles Schwab or some other large mutual fund company. You might not know they actually have a brokerage service or a brokerage arm of the company. As these companies start expanding their financial abilities to offer different products and services to people. So if you have already some existing mutual fund account, particularly if it's outside of, like, let's say a government or a employer-sponsored account that has some special tax advantages that you might have. In the United States, as an example, they would call it 401k. So anything that's outside that, look at them. They might offer you some brokerage services where you could buy and sell individual stocks as you want. What you're looking for is anytime they're referring to something like a brokerage account, it would be a separate account than maybe your regular mutual fund account, be separate than any kind of tax advantage account, and they could set that up as an account for you as far as a brokerage account where you could buy and sell individual stocks right through your mutual fund. And they'll quote you the prices and everything too there. It might be certainly lower cost than a full service stockbroker as well, and might compete very well with these online discount brokers. So if you have mutual funds out there, look for brokerage accounts. Now, if you don't want to try it and buy and sell individual stocks anyways, you like exchange traded funds or mutual funds, well, your mutual fund company would do that all the time anyway. So then you can look strictly at mutual funds, looking at the stock mutual funds, look at the different style boxes, expense ratios, all those things we learned about, and go out and pick different mutual funds for your portfolio and your stock portfolio. One thing about mutual funds and exchange traded funds, as we learned, is exchange traded funds are like buying stock on an exchange. So there's no exchange traded fund company. There are, like, let's say, mutual fund companies that sell mutual funds and sell exchange traded funds, with the ability to buy exchange traded funds, or you're buying from other sources these exchange traded funds or mutual funds. You're buying it through the mutual fund company. So there's no Vanguard ETF Corporation. It's Vanguard, and Vanguard sells mutual funds and they sell exchange traded funds. And by the way, they have a brokerage service too, where you can buy and sell individual stocks as well. And that's all going through a mutual fund. You can do all your transactions through them versus, let's say, an online discount broker like Charles Schwab, or like a better example would be like E-Trade, or a full-service stockbroker like Merrill Lynch, for example. So take a look at your existing mutual funds you have, and they might have already the different options that you were interested in: individual stocks, exchange-traded funds, and mutual funds. These big companies like Fidelity and Vanguard already have all that, and maybe that's the way to go to buy and sell stocks. Do you have a faucet that leaks or kind of drips? Well, that's no fun. That can be really annoying. But drips in investing could be a lot of fun and something you might be interested in, and can be serve you very well. So what is a drip? It's actually a thing. What is a drip? A drip is a dividend reinvestment program. That's what it stands for, dividend reinvestment program. So what's involved with a drip is you're buying stock directly from the company itself. So if you're interested in stock A, you would go to that company, and typically online, you can order stock directly from the company. You don't have to go through a discount online broker or a full service broker or a financial planner or anything like that. I can just buy stock directly from the company. And boy, isn't that a great cost savings potentially by buying stock directly from the company? It sounds great. And the reinvestment part is its dividend reinvestment program. Is the idea you're buying, this would be mostly for, there's a couple out there, I can't remember who they are, but it's mostly just a few, and it's only a few dividend paying companies that allow you to buy their stock directly, and then you can reinvest the dividends in the company, or cash them out too. And that's why they're called a DRIP, or dividend reinvestment. You're buying the stock directly from the company and then reinvesting those dividends right in the company too. So it sounds great. Now here's the downside of it. One, it's very rare. It's very rare for companies to offer, because they don't want to manage all that. They want to be listed on a stock exchange, have people buy and sell their stock on the exchange, and then they pay out the dividends to their shareholders, or their owners in effect, like normal. They don't want to have a separately managed thing with employees trying to manage this whole investment thing of this DRIP or dividend reinvestment program, because while they're doing the DRIP, they're still listing on the exchange. They're still paying out dividends directly to, or paying out dividends to the shareholders who bought through the exchange, bought the stock individually, or maybe own stock as part of a mutual fund or exchange traded fund. So they're doing all that already. So they don't like the idea of creating a DRIP just to handle this small group of people directly. But some companies do offer it, and it's a great way to buy stock, particularly if you like a particular stock. Check out to see if it offers a DRIP. Typically, like a big Fortune 500 company, a Fortune 100 company, good long-time paying dividend companies, they might offer a DRIP. So when you're on the website, what you're looking for in the investor section is you're looking or searching for DRIP or dividend reinvestment program. One thing when you look at the dividend reinvestment program, if you find a company that's offering it that you're interested in, is really look closely at the minimums and other details such as fees closely, because it's usually a pretty good deal, but understand it might not be, depending if you have to maintain a certain minimum or what you might have as far as rules around, that you have to reinvest the dividends, or can you cash out the dividends, or how long you might have to hold the stock for. Remember, they're just making up a special deal for you outside the market, so they have a little bit more control on the liquidity and the other rules around that stock. So you buy a stock on the stock market, you could sell it 2 hours later or 2 minutes later, where if you buy it through a DRIP, there might be limitations around that. Also, you buy in a stock market, there might be different types of minimums out there as far as just needing to be able to buy the stock, whereas in a DRIP program, it might be a real hefty type of minimum. And it all varies by companies. There's no standard with this, and only a few companies offer it. So I would say first thing is do your due diligence, look at companies, and if you're looking at dividend investing, narrow your field down to dividend investing stocks. And if you've got a couple in mind, check out their website. You'll be doing it anyways, doing your due diligence to research the company. But it might be worth it to go to the investor relations section of the website or of the company information page and find out, or you can just ask them directly, send them a note to the investor relations section. They usually have an email you can send quick questions to and ask, do you have a DRIP or a dividend reinvestment program? If they do, it'll be right there on the website, and you can usually pull up the document and you can see what are the different minimums and things involved. So DRIPs, rare, but if you find one and you like it, might be a great way and a little bit different way to invest in stocks, and particularly you're looking at dividend stocks that will then be reinvested. Okay, so you've settled on different types of companies or mechanisms to help you actually buy and sell the stocks, right? Now, maybe you're with a full service broker, or maybe with an online discount broker, but now that you're with them, you got to tell them that the stocks you want to buy and sell, and there's different types of ways that, as far as you can set that up and how you want to buy that stock and how you want to buy and sell that stock, and that's called order types. Now, if you are investing, let's say, in a mutual fund or exchange traded fund, where all that's being handled by either the manager who handles the index or an active manager who's doing all that for you, you don't have to worry about any of this stuff about order types. So mutual funds, exchange traded funds, forget it, you don't have to worry about order types. But if you're ordering, let's say, through an E-Trade or a TD Ameritrade, or you're ordering through Merrill Lynch, they're going to have different types of order types. You have to tell them what is your order. It's more than just saying, I want to buy and sell a stock. You need to tell them, obviously, I want to buy this stock and what the ticker symbol is, like a 3 or 4 digit name, like Wells Fargo Corporation, the bank is WFC, Wells Fargo Corp, so that's the ticker symbol. And how many shares of that stock you want to buy too. And depending on the full service or discount broker, maybe they have a minimum amount of dollar amount you got to spend or minimum amount of shares you have to buy. So you want to look into that too. So basically you want to know the stock you want to buy, its ticker symbol. The online stuff can help you with that. Your full service person can do all that for you. How many shares you want to buy, which is, how much dollars you want to spend. So if a share is $100 per share and you buy 5 shares, well, you need to come up with $500, $500 US, right? So the ticker, the shares, and now you got to tell them what type of order type do you want to have. And here we're going to look at the most common order types that are out there, ones that almost everybody uses, 90% of the investors use, but I tell you, you can get really exotic too, real weird and more exotic types of order types. Well, let's look at the 4 main order types that people use day in, day out, every day in the stock market. The first order type we'll look at is a market order. So when they say, I want to place a market order, I want to buy 100 shares of Apple Corporation and I want it to be a market order. So what that means is you're buying and selling immediately at the current market or current price that it's selling at, right? So you're not waiting, there's no delay. It's as soon as they can process the transaction, they have somebody who will sell them the shares, it happens immediately. And certainly with very liquid or stocks are traded on the most biggest exchanges and things, that's happened almost pretty much instantaneously once they put the order in. So a market order means I'm buying or selling immediately, and I'm buying whatever the current price is. So if the price goes down in the next 5 minutes, like 100%, well, then you're buying at that price. So understand, a market order, you're buying and selling immediately at the current price. A limit order is where you want to set some maximum or minimum prices that you're willing to buy or sell at. So maybe the stock's trading at $50 and you put in a limit order and say, oh, it's trading at $50, I want to buy 100 shares, but my limit order is a 52 on the max, so that means I don't want to pay more than 52, and maybe a 48 on the, let's say on the max, on the limit order on the max part would be that. Or let's say if you want to sell a stock and it's currently selling at $50, maybe you don't want to sell it for anything less than $50 or $49, let's say, and if it dropped all of a sudden real fast to 35, you don't want to sell it, you want to hold it. So limit order is really setting the maximum and minimum prices you're willing to buy and sell. So that market order, it's just executed immediately, whatever the market price is. Limit order, you get a little bit more control on the maximum and minimums and setting a range for what you want to sell it at. So why wouldn't you always do it as a limit order? It sounds like more protection for you, right? Well, it is, but it also costs more per transaction. It's part of the fee structure and how these brokerage companies, whether they're online or full service, make money. So market order would be less expensive than a limit order. But either way, you can use it depending on what you're looking to do. Another one is called a stop order, and really is known as a stop loss order. And that's basically, you're leaving an order out there, it's going to sit out there, and it's going to be dormant until a certain price condition is met. So if you bought a stock at here and you want to protect your downside. Let's say you bought it at $50 US and if it got down to 45, you want to sell it right away. You don't want to write it all the way down to 30 or 20 or anything like that. You just want to stop that loss. That's why it's called a stop loss or stop order. And you can just leave that order out there for a period of time. They might ask you to renew it, and there's some costs associated with that. And then it only gets active, it only happens if that was to happen. So if you bought it at 50 and you put a stop loss at 45 and the stock keeps going up to 50, 60 and on and on and on, and that's great. That stop loss order never comes into play. It's never executed. It's only executed if the stock comes down. And so it's basically an order that's out there that's existing and ready to implement once the condition is met. Once again, a little bit more costly than, let's say, a market order where you're buying and selling immediately. Related to that too is a good till canceled or GTC ordered, but you typically know as good till canceled. That means you place an order to buy or sell is in place, and it's in place until canceled, right? Now the brokerage limit, and that's canceled by you, for example. I say, I want to buy this stock at, whatever, this price, and I want to leave this type of order in place, this limit order or this market order. I want to leave this in place. Well, not in a market order necessarily because that's immediate, but I want to put some type of order out there and leave it in place and leave that good till it's canceled. Now, and that canceled by me, the person putting in the order. Now, the brokerage house may limit the time on it. Typically, it's around, let's say, 90 days, both online or full service brokers. And they may limit the time you could have this good till canceled out there without having to renew it and incur some extra fees. But the idea is I have the order out there, it can sit out there, and it doesn't take place until certain conditions are met. So maybe I want to buy a stock, and maybe the stock is trading right now at $50, and it might go up to 51 or 52, and I don't want to pay that much, but heck, if that stock's a good stock and it ever got down to 45, boy, I would buy it in a heartbeat, right? Well, you place a good till canceled order, that says if this stock goes to $45, buy it at 45. Or it might go down to 44 and a half or something right around there. But once it hits 45, the order is implemented. And that's good till canceled. So maybe it's 52, 53, 49, and it's bouncing around, and then the 90 days passes, and the brokerage house or the online discount broker says, hey, your thing's going to expire. It's coming up in 90 days. Do you want to renew it? You can decide whether you want to renew it and incur some additional fees or just let the order be canceled or cancel the order. So that's a good till canceled order. So if you're not sure to take a market and just buy it right away, you can put a good till canceled order in there. Okay, so those are the four most common ways. You see how it builds from just a basic market order of I want to buy this stock or sell this stock and at the current price to getting things a little bit more exotic, a little bit more difficult maybe. It goes from there even further. But if you can master these four, you're perfectly fine. And in most cases, I'm just using market orders all the time anyways. It's not like stocks are selling at 50 and they immediately in 2 minutes drop to 30 or something. I guess it happens, but and certainly when everything's going down and people are selling like crazy, you can have that volatility maybe, but or buying like crazy. We have extreme volatility, but usually you don't have to worry about some of these other orders as much, but they're out there and you can use them to your advantage. The only advice I'd have, well, the big advice I would have for any of this order type, and really most things like I said are market orders, pretty easy to understand, buy and sell immediately at the market or current price, but really understand the order you're placing there. So if you're putting in a limit order or stop loss or good till canceled or some other type of really weird exotic order out there, just ask yourself, do I understand what I'm doing here? Do I understand what my order is, and am I understanding what I'm trying to get out of it? Why am I placing a limit order here? Do I need to incur that extra cost and have a limit order? Could I just do a market order? Or do I need a stop loss? Can I just be watching the market and not have that? Or that kind of thing. So it's something to ask yourself as far as the order. But the main thing, understand what you're doing and what you're trying to accomplish with that order. What is your strategy behind that order if you're doing something exotic more so than a market order? And is it really worth it to do it? Those are questions you would answer yourself. But just really, for the most part, understand the orders you're placing, and you'll be way ahead compared to most folks who are like just not sure. They're just trying different stuff. So when in doubt, just use simple market orders, buy the stock, and be done with it.